Most investors still think about residential property in very simple terms. You buy a flat, you rent it out, you hold it. For a long time, that approach worked. But in today's market, this logic no longer explains how value is really created. In this video, I will explain how build-to-rent and co-living should be assessed from an investment perspective and why, when designed and operated professionally, they can outperform traditional buy-to-let strategies on a risk-adjusted basis. We will look at what truly drives value, how risk is assessed differently, and why structure and operations matter far more than most investors realize. I am Francesco Fasanella. I am the co-founder of Habitat Investments, a real estate advisory and development-focused firm, and Habitat Living, an operated company managing co-living and rental assets on a day-to-day basis. I work directly with medium-scale build-to-rent and co-living projects, not only at acquisition or development stage, but once they are live and operating. This operational perspective is essential because assets like these sit in a very specific position. They are residential in use, but they behave much more like operational real estate. Understanding this distinction is the first step to assessing them properly as investments. Now let's take a step back and look at the market context. Rental demand has increased, affordability has tightened, and in cities like London, the way people live has fundamentally evolved. As a result, new residential formats have emerged, particularly build-to-rent and co-living. Yet many investors still analyze these assets using the same framework they would apply to standard buy-to-let flats. That is where misunderstandings begin. Not because these assets are more complicated, but because they operate under a different logic. Let me ground this with one example. In West London, we recently delivered a co-living asset through redevelopment and reposition. It consists of 10 self-contained units. Each unit rents at an average of around £1,400 per month. On the surface, this looks straightforward. 10 units at £1,400 per month means 14,000 of gross monthly income, or roughly 168,000 per year. At this point, many investors stop and think, that looks attractive, but here is the real question. What does that income actually represent from an investment perspective? Because income alone does not define value. Let me ask you another question then. If you take a standard flat in West London rented, for example, at the same level of £1,400 per month, how do you normally analyze it? You look at the comparable sales, you look at yield, you assume relatively stable cost and limited operational involvement. Now compare that with a 10-unit co-living asset delivered through redevelopment. Higher income potential, active management, operational decisions that directly affect performance. At first glance, it may appear more demanding. In reality, this is precisely where the advantage lies. Buy-to-let is simple because there are very few levers you can pull. Co-living and build-to-rent are more sophisticated because they allow you to actively control income quality, cost efficiency, and risk over time. These assets are not just residential but bigger. They are income-driven platforms. And when designed and operated correctly, they tend to outperform traditional buy-to-let strategies on a risk-adjusted basis. This is why analyzing them with residential shortcuts leads to wrong conclusions. Before we talk about yields, valuations, or refinancing strategies, it is essential to understand what fundamentally drives these assets. At their core, build-to-rent and co-living are income-led investments. So location matters, design matters, but operational execution matters just as much. That is why these assets sit closer to operational real estate than to passive buy-to-let investments. Value does not exist in isolation. So value is a function of income quality, risk, and structure. And to understand how these assets are assessed professionally, we first need to be clear about what we actually mean by value. So we looked at what build-to-rent and co-living really are, and why analyzing them like traditional buy-to-let assets often leads to wrong conclusions. Now, let's move to the numbers, because this is where perceived complexity either turns into confusion or into value creation. We are looking at a 10-unit co-living asset delivered through redevelopment in West London. Each unit rents at an average of 1,400 per month, and that gives us 14,000 per month, or roughly 170,000 gross annual income. At this stage, many investors feel comfortable. But gross income is not what drives value. Instead, the net performance does. And this is where co-living and medium-scale build-to-rent need to be understood properly. Income in these assets is not passive. It is the result of operations. And operations come with costs: management, maintenance, utilities and services, turnover and voids, realistic contingencies. In large-scale co-living models, operating costs often sit in the 30 to 35% range of gross income. But well-designed, medium-scale assets operate very differently. When the asset is the right size, the layout is efficient, and management is directly controlled. Operating costs can be kept materially lower. Indeed, in our case, operating costs sit in the 20 to 25% range. The difference is not marginal, it is structural. On 168,000 of gross income, a 20-25% cost base means approximately 42,000 to 50,000 per year in operating costs. That leaves around 120,000 of stabilized net income before financing. This is the number that actually matters. Let me pause here for a moment. Two assets can generate the same 168,000 of gross income. But if one converts that income into 120,000 of net performance and the other into 90,000, they are not comparable investments. And yet, this is exactly the mistake investors make when they analyze co-living through a buy-to-let lens. Value in these assets is not driven by headline rent. It is driven by the quality and durability of net income. This is why professional investors and valuers rely on an investment method rather than simple residential comparables. Once the income has been established, the next question is risk, because income only becomes value once it is filtered through a yield. A yield represents the return investor requires for the risk they are taking. And so lower perceived risk means a lower yield and higher value. Higher perceived risk means a higher yield and lower value. So let's apply this to our example. We assumed a stabilized net income of 120,000 per year. If the asset is well located, efficiently operated, and supported by a clear operating track record, an investor may be comfortable with a yield of around 5.5%, for example. That implies a value in excess of 2.1 million. Let's consider the same build, with the same income today, but higher perceived risk, short operating history, less confidence in cost control, greater sensitivity to execution. In that case, an investor may require a yield closer to 6.5%, for example. That reduces value to around 1.8 million. Same building, same gross income, different outcomes. So basically, what changed was not the asset. What changed was the perceived quality and resilience of income. This is one of the most misunderstood points in co-living build-to-rent investments. And so investors always focus on pushing rents, but value is created by improving income quality, controlling operating costs, stabilizing performance, and reducing risk over time. Is where professional operation becomes a competitive advantage. In medium-scale build-to-rent and co-living, good operators are not simply managing complexity. They are converting it into efficiency, and that efficiency feeds directly into value. Which brings us to the next layer. Once income and value are understood correctly, the question becomes, how should these assets be structured? Because once that is introduced, income, value, and structure become inseparable. So we said that once income and value are understood properly, the final layer is structure, because value on its own does not make an investment work. Structure does. This is where discussions around build-to-rent and co-living often become misleading. There is a common assumption that if a lender is willing to provide debt, that investments must be sound. This is not how professional capital works. So debt does not validate an asset. Debt amplifies the assumptions behind it. So let's go back to our example then. We have a co-living asset with around 120,000 of stabilized net income before financing, delivered through redevelopment and operating as a 10-unit scheme. From a lender's perspective, the starting point is not headline value, it is cash flow, because the key question is simple. Can this asset service debt consistently, even when conditions are not perfect? This is why lenders focus not only on loan-to-value, but on debt service coverage. Debt service coverage is the relationship between net operative income and the cost of servicing debt. An asset can look conservative on a loan-to-value basis and still be fragile if cash flow margins were thin. This is particularly relevant in income-led operational assets. In co-living and medium-scale build-to-rent, income can be strong, but it is also exposed to operational variables: cost inflation, turnover, occupancy volatility, execution quality. This does not make the asset weak. It means structure has to be realistic. So let me ask you this. What happens if utility costs increase? If turnover is slightly higher than expected? If occupancy softens for a short period? In highly leveraged structure, small changes can have outsized effects. And this is why debt should be sized around resilience, not optimism. Well-structured projects are not those that maximize leverage. They are those that preserve margin. A resilient structure is one where net cash flow remains positive after debt assumptions are conservative. The asset does not rely on perfectly timed refinancing events to remain viable. Refinancing is often presented as a success milestone, but in reality it is simply a snapshot. It reflects how a lender perceives risk at a specific moment in time, under specific market conditions. Cash flow, on the other hand, is the ongoing reality of an investment, and this is where equity plays its real role. Equity is not just capital. Equity absorbs volatility. Equity protects downside. Equity provides flexibility. Yes, projects with appropriate equity levels may look less aggressive on paper, but they tend to be far more durable over a full cycle. And this is particularly important in co-living and medium-scale build-to-rent, where value is not static. Value is shaped continuously by operational decisions, cost control, tenant experience, and asset management discipline, which leads to a critical point. In these assets, operator quality matters as much as location. Two identical buildings can produce very different outcomes depending on how assumptions are set, how costs are controlled, how income is stabilized, and how risk is managed day to day. For investors, allocating equity is therefore not just about asset selection. It is about operator selection. Experienced investors understand this. They look beyond headline returns and focus on downside protection, margin for error, and structural resilience. They ask different questions. Is this asset structured to maximize a short-term valuation outcome? Or is it designed to generate sustainable income through cycles? Because in the long run, predictability and capital preservation often matter as much as upside, especially in environments where interest rates move, financing conditions tighten, and operating costs fluctuate. In these conditions, the ability to adapt, to refinance opportunistically rather than out of necessity, and to keep generating cash flow becomes a competitive advantage. This is how value should be understood in build-to-rent and co-living. Value is not just a number achieved in a single point in time. It is a characteristic of an asset that performs under different conditions. Income quality drives value. Yield reflects risk. Debt amplifies outcomes. Equity absorbs uncertainty. Cash flow anchors the investment. When these elements are aligned, value becomes durable rather than fragile. This is the framework professional investors use when allocating capital responsibly. And this is the framework we apply when creating and managing modern-scale build-to-rent and co-living assets over the long term. So not to just chase numbers, but to build investments that remain investable through cycles. So build-to-rent and co-living are income-driven operational investments. Value is created through income quality, risk management, and structure. If you want operator-level insight into how these assets are assessed, structured, and managed in practice, follow the channel and subscribe. Thank you.